Developing a trading plan and sticking to it are the two main ingredients of trading discipline. Now, a successful trading plan goes hand in hand with good risk management, and both need to be in place to help limit trading mistakes and minimize your losses. It will also help you weather market moves that are relatively unexpected as well. Now, every trader needs a trading plan, and without one, you are setting yourself up for failure in the long run. It's very common for new traders to make money on demo accounts, but many times those same traders lose when entering the live market, simply because they fail to exercise discipline when real money is involved. A solid, well thought through trading plan removes any spur of the moment bad decision making, while a plan should be in place for every potential market action. Now, a successful trading plan will determine how you plan to enter and exit trades. It will also determine the amount of risk to be taken and help formulate short and long-term investment objectives. Most plans require the use of various types of technical analysis tools. A trading plan is also a framework to measure your trading performance. The first step in building a trading plan is to find a trading style that suits your personality, and only from there can you really define what kind of method suits you, because strategies, systems and methods which aren't compatible with your profile and your personality will only drastically lower your chances of being successful. Now, to help you clarify your trading profile, what it is and how to shape your trading plan, ask yourself these questions. What is your motivation to be a Forex trader, and what are your goals? By making your goals specific and measurable, you'll be able to monitor your progress and see whether you are actually improving or not. What is your risk capital, and how much money can you actually afford to lose? Now, Forex trading should only be done with risk capital, and risk capital is money that you can afford to lose. So don't start trading Forex with real money until you've accumulated enough risk capital. How much time can you dedicate to Forex trading? Now, with this one, you need to seriously consider how much trading will actually affect your current lifestyle, and your time and your availability. This will all determine your trading style. Work out how much time a day, week or month you can actually dedicate to Forex trading and managing a trading system. Remember, the shorter the time frame you are trading, the more time you need in front of the charts. Now, on the flip side, the longer the time frame you trade, the less you have to watch the market, which means you can technically simply check your trade from time to time, as long as you have your stop loss in place. What kind of returns do you expect to make from Forex trading? Now, the answer to this question will help you determine what kind of trading style you will actually implement, what currency pairs you will trade, the time of day that you will trade, and most importantly, the risks involved in achieving your goals. Remember, the more ambitious your expected returns are, the more trades and bigger risk you'll have to take on, which will mean more exposure to potential losses if you want to achieve your goal of returns. The next one, what is your daily pre-trading routine? Your pre-market routine will be critical to your success as a trader, as it helps you plan your day. Now, during your pre-trading daily routine, you should review any open positions and make any necessary adjustments. Also review yesterday's trades, get yourself up to speed on the market and exactly the key trading events or data releases for the day ahead, which could cause some volatility in the financial markets. And finally, be ready to trade when the next trading session opens. When to trade is often missed by traders, as many markets somewhat define when you are actually able to trade. For example, if you're a stock trader, you can only trade when the market is open. But saying that, even then, many traders choose to focus on the first or last hour of the trading day, as this is where the majority of volatility will often take place. But this is not the case so much for the Forex market, which moves 24 hours a day, which also means there is a lot more flexibility available to the trader, but at the same time, it's exactly the reason why you need to decide which trading session works for you and your lifestyle, and stick to it. Now, whatever operating hours you decide, just make sure you're able to commit to it consistently. If you're new to trading, once you've laid out some guidelines on how you will enter and exit trades, I strongly advise that you trade on a demo account first to build up your experience, practice discipline, and put your trading plan into motion, all before you open a live account. Now, the demo account is the tool designed to enable you to practice using the platform in a risk-free environment. Once you've achieved consistent success on a demo account, then it may be time to move to a live trading account. But remember, it will be a learning curve with live trading compared to demo trading, as conditions are slightly different. And of course, because real money is actually on the line, your emotions will most likely come into play. Your stop loss and take profit are two ways in which you can plan ahead when trading and also manage your risk. Placing stops and limits will automatically close the trade when the market reaches your chosen level, and this is what will help you gauge potential maximum losses and also expected returns. It also works as an aid in taking emotion out of trading. Remember, large losses are extremely difficult to overcome, so you need to stick to your stop loss rule. There are no rules that regulate how traders can use stop and limit orders to manage their positions, so deciding where to put these control orders is a personal decision, depending on how much risk you want to take. For some traders, they decide that they are willing to incur a 30 or 50 pip loss on their position, while other more risk-averse traders may limit themselves to only a mere 10 pip loss. Whatever you decide, your target or limit should be 2 or 3 times your risk. In terms of how much you should risk per trade, try to limit your risk to 2% per trade. This is when risk-reward comes into play, and you should calculate a risk-reward ratio of a trade before you establish a position. A risk-reward ratio can be different for each trader, and it is based on personal preference or a particular type of trade. Now, as a new trader, it would be wise to stick to a low-risk, high-reward ratio, as it could help lower your potential downside. Now, one way to effectively manage an open position is by using a trailing stop. A trailing stop automatically updates the stop order price as the market moves in your favour. With our trading platforms, you can place a fixed trailing stop, which will actually help you to continue to lock in profits on an extended move as the trend moves in your favour. Now, maintaining discipline and managing your trading risk is vital for consistent and profitable trading. As a beginner trader, it is wise to evaluate each losing trade and keep some kind of journal or log that you can refer back to see exactly where you went wrong or what worked out.